Mr. Oppenheimer, thanks for joining me.
Thank you.
Thank you.
According to your recent report, we had better macro momentum in 2023. So which part of macro environment do you think will be improved? And does that mean we are more likely to have a higher return on investment in 2023?
Yes, we do believe that the economic environment is improving globally. And I think that firstly, we didn't believe the US would have a recession this year. A few months ago, the consensus was that a recession would happen because of rising interest rates. And we believed that the labour market would stay relatively strong. Inflation would come down as a result of higher interest rates, but they wouldn't need to raise interest rates enough to force a recession. And we have more confidence in that view now, that the US will avoid a recession. But also, we've had two other important improvements over the last few months. In Europe, the surge in energy prices that we were seeing a year ago has moderated. The weather has been very warm, and that's helped to reduce the demand for energy, bringing prices down. That reduces the risk of a European recession. And of course, we've had the opening up of China as well, and further stimulus in China, and that's improving the prospects for the Chinese and the global economy. So in combination, we think the macroeconomic outlook for this year is going to be better than people were expecting just a few months ago. We've also seen evidence that inflation is starting to moderate from the high levels that we were seeing last year, and that will also help to generate a softer landing.
You think the market is so optimistic right now that it may be disappointed later on. Is this the biggest risk, in your opinion, to the market in 2023?
Yeah, I think that the relatively positive macroeconomic outlook that I described is being fully priced now. We think equity markets are pricing a soft landing. At the same time, bond yields have come down, and that suggests there's more confidence that inflation is going to moderate. So there's a lot of good news now priced into markets, and I think there is a risk that at some point in the next quarter or two, investors start to question the likelihood of that outcome. Maybe interest rate expectations will need to start to rise again, and we've seen some evidence of that in the last few weeks. And that will create some tensions in financial markets. There's also a risk that we get the debt ceiling hit in the US, and that could temporarily close the operations of the US government. We saw that happening in 2011, and that triggered some uncertainty, and at least in 2011, a correction in equities, and we could see something like that happening again later this year.
You said that valuation mattered for the first time since the global financial crisis in 2022. Will this feature persist in 2023? And what does this mean for investment strategies?
Yeah, I think that the reason we've argued that valuation has mattered is that it's been a very long time since investors have really focused on valuation. Because after the financial crisis in 2009, interest rates around the world fell to record low levels, and that pushed up the valuation of companies that had high expected growth. And generally speaking, those companies became more and more expensive over the following 10 years. Whereas traditional industries that were suffering in the aftermath of the financial crisis, things like the bank sector, the commodity sectors, these were cheap but had very poor fundamental growth, and generally investors ignored them. Over the last year, as interest rates around the world have started to rise again, it's had the opposite effect. It started to push down the valuation of very expensive companies, in particular in things like the technology industry. But the very cheapest industries have started to see better returns and more interest from investors. So valuations last year mattered. The companies and markets that started the year with the lowest valuations generally outperformed, and the ones that started with the highest valuations generally underperformed. And we expect that valuation is going to be an important part of the focus of investors this year. So focusing on areas where there is relative value, cash and pockets of credit within the equity market, things like banks, energy, commodity related sectors. We think these will all be a continued focus through this year.
The US equity markets remains much more highly valued than its long-term average, and you expect limited upside in US equities in 2023. But there will be more opportunities in non-US markets. So which non-US markets are you referring to?
Just to add to this point, the reason that we have quite a flat return in the S&P is because the valuation, the price-earnings ratio is well above its long-run average, but we expect very little profit growth. In fact, no profit growth this year for the whole index. And so overall we expect very little return. The advantage in many of the markets outside of the US is that they have lower valuations. The price-earnings ratios are lower than average, and their dividend yields are higher. The highest returns we have forecasts are across Asia, in places like China and Korea, but also Japan. But Europe also looks quite attractive from a valuation perspective. It benefits more than the US does from a recovery in the Chinese economy because it has more exposure there. And it also has more exposure to these value sectors, which are now seeing better fundamental growth, things like banks, energy, commodities. So generally we continue to prefer markets outside of the US to the US, but in aggregate we still see relatively low returns at the index level across equity markets this year.
In particular, what is your forecast on China's market?
And of course we've seen a very strong rebound already as investors have got more confident about an opening up, but we are looking at pretty strong profit growth over the course, not so much of this year, but next year, and that should drive the equity market higher because that's one of the strongest market regions for profit growth in our forecasts. You compare that to the US where we have zero profit growth for this year forecast and just 5% for next year. So we think that China still stacks up as being quite attractive in terms of an acceleration of profit growth, but with still a relatively low valuation.
What is the most important message you want to deliver to market investors in 2023?
Well, I think there are two messages. First of all, diversification, and second of all, focusing on value. Now, if you look at the decade after the financial crisis, neither of these things really mattered very much. Diversification didn't really help investors. If you think about equities, the best performing market was the US, and technology, being diversified would have reduced returns. We now think that being more diversified across regions and sectors will help to boost risk-adjusted returns. And the second point about valuation is that cheaper markets and cheaper sectors we think are likely to perform better over the course of the next year compared to the period in the decade after the financial crisis, when generally cheaper markets and sectors and industries tended to underperform. So I would focus on diversification and value.